Hello, everybody. Good evening, good afternoon, or good night, depending on where you're joining us. Thank you for joining us tonight. We'll just give it a couple seconds before we get started and just let a few more people join. Just 30 more seconds. All right, and I see more people have come through, so just gonna get started with tonight's webinar. So again, thank you for joining us, and I just wanted to real quick before we start the webinar, read this disclaimer, which is that the information contained herein is intended to be used for educational purposes only, and it's not exhaustive. Diversification and or any strategies that we might discuss are not a guarantee against investment losses, but are intended to help manage risk and return. If applicable, historical discussions and or opinions are not predictive of future events. The content is presented in good faith and has been drawn from sources believed to be reliable, and the content is not intended to be legal, tax, or financial advice. Please consult a legal, tax, or financial professional for information specific to your individual situation. And as always, if you would like a copy of our Form ADV or our privacy policy, you can reach out to us via the phone number on the screen or our email, which is info@ymwadvisors.com. So having that out of the way, tonight's webinar, we're going to focus on the topic of before it's too late, right? So we're going to cover financial psychology, financial planning, and our market outlook. So we'll start with financial psychology aspect, and we'll have Dr. Brad Klontz to take us through it. And I believe he's going to talk about the psychology of spending in retirement. So I'll leave it off to Brad to take it off.
Thank you so much. And I'm glad I figured out how to unmute myself. So I wanted to talk about the psychology of spending in retirement, because this is an issue that I have run across with many individuals I've worked with, as well as a lot of the research we've done around people's psychology around spending money. And one of the best ways to understand this is by thinking of the phases of our financial life. So this is the financial life cycle. We have a period of accumulation where we're trying to build our portfolio. We're trying to grow it. We're trying to advance ourselves in our careers and our ability to make money. And then there's the transition phase where we're nearing retirement. We might be moving a little bit more conservative, visualizing that ideal retirement in that transition phase. And then you have the distribution phase. So this is where the money reverses the flow of direction, or the direction of flow. So all these years of holding on to that money, keeping it, managing it well, saving it for the future, investing it, saying no to all the temptations along the way. No, I'm not going to take from my 401k. I'm not going to take from my IRA because I have this goal of financial freedom at a certain age. So unfortunately, those of us who are the best at accumulating money can have the most difficult time with this distribution phase. And if you think about it, it goes against everything you've been doing your entire life. And as a matter of fact, you probably can think of friends, family members who weren't so good at that accumulation phase and that preservation phase. And what they were doing was drawing from their retirement accounts. And so many individuals who are really, really successful at having their discipline to save for that nest egg have a real difficult time when we are asking them to do the exact opposite and start drawing from that. And as I'm talking about this, perhaps you're starting to sweat and feel anxious about the thought of taking money out of your retirement accounts. I just wanted to say that this is a very common experience. And the research we've done on people who tend to have the highest net worth, they tend to be money vigilant. And I know my partner Bora talked about money scripts in the last webinar. And money scripts are these beliefs we have about money. They drive our financial behaviors. Quite often we've learned them in childhood. They've been reinforced as we've grown and developed. And the money script that's associated with the highest net worth and the most likely behaviors regarding saving and investing for the future are money vigilant scores. Now, money vigilance has beliefs that involve anxiety. There's some anxiety associated with it. If you don't have some concern, worry about the future, why would you save and invest right now? And it turns out that people who have those biggest nest eggs, because they're so disciplined, have some worry about the future. They're worried about not having enough. And so we're asking you to do what you've really worked hard to not do your entire life, which is take money out of your account. Now, part of some of the objections that I will hear along the way, because since we have this belief that there's, that it's important to save, it's important to invest, we will develop other beliefs to try to combat any desire or any impetus or recommendations to take money out of our account. And so we might ask ourselves, like, well, how do you determine how much is enough? So a financial plan was run for you, all the probabilities, the Monte Carlo analysis, the 10,000 analyses with all the different factors being adjusted, like inflation and rate of return and all these factors. So you've been probably given a percentage of success, probability of success, but you might ask yourself, yes, but how do I know that's enough? How can we really predict the future? And these are legitimate questions, because we really can't predict the future. And what is that enough? What is that? So part of what we need to do is define what enough is. What is enough money? And a lot of times it has to do with our quality of life. We also may fear spending money because we're worried that our advisor is wrong. Maybe in our financial plan, we've predicted that you live to be 96, and what if you live to be 105? And hopefully you will, but there's some anxiety there, right? What if I run out of money when I still need money? Or what if we are basing our predictions on overestimate of future returns based on historic returns? You may ask yourself, what's my vulnerability there? So these are legitimate questions, and I think things that are really important to discuss, because we can't predict the future and we don't know anything for absolute certain. What I typically see, though, is that a lot of it has to do with our psychology on a deeper level. So we have these rational ideas around, is it enough? And these are things that we need to explore. But even when, 10 out of 10 experts would suggest to you that, yes, you probably have enough, or there's a high probability you will, or there's a 99% chance that your financial plan won't fail, and you still have trouble spending, I think it really pays to look into your history around money. So if you grew up with a lack of financial resources, so let's say you grew up poor, let's say you grew up lower middle class, you grew up with these beliefs that, oh, there's not enough money, perhaps there'll never be enough money, you could have a deep-seated fear about not spending. And I'm thinking of a bunch of people that I knew who lived through the Great Depression, and maybe some of these individuals, maybe you did, but that was an entire cultural experience of not having enough money. And it led to an entire generation of people who were highly anxious around money. Many of them became hoarders of even simple things. One person from that generation, I remember, would use bars of soap down to a sliver and then save them. So underneath her bathroom sink, she had hundreds of bars of soap with just a little sliver, just in case she needed to, didn't have enough money for soap someday. And these are things that people don't necessarily think about, but it's sort of hardwired into their psyche because of that trauma of not having enough. So quite often individuals who really have trouble may have come from an experience, or even their parents or grandparents came from an experience where there was tremendous lack. And so every fiber in their body saying, don't spend the money because there might not be enough. Or perhaps you've experienced a financial loss at some point in your life and you went through a period. So you didn't necessarily grow up in that environment, but you went through a period of lack. And that can sort of hardwire this anxiety about spending money. And I just want to say that it's normal. So it's really important to understand that the people who are the best at saving and investing are the ones who are the most likely to have difficulty spending and enjoying the experience of spending. And quite often as financial advisors, we're like, look, you should spend some money. Based on the projections, we would love it for you to do this. Spend some money. And I'll talk a little bit more about some techniques you can use to help yourself address this fear of spending. And I know part of what you're thinking is Americans should have more fear of spending. And I think we would all agree that that's probably true. But many of us who have had that level of discipline, put all that time and effort into saving money, it's hard. I got to tell you, it's hard to watch people continue to suffer with this. There's not enough when by every objective measure, there looks to be enough. And so as an advisor, as someone who cares for them, it's hard to watch people neglect time with their family, when I know this is a value of theirs, but they're so anxious that they can't stop working. Or perhaps they're neglecting medical care, neglecting taking a vacation. So these are things that we see that we get concerned about our clients because we want them to be able to enjoy these resources. I mean, what's the point, right? What's the point of having an abundance of resources if you can't enjoy it? So what I will do with some individuals who are willing to explore this a little bit, after talking with them about how normal it is to engage in exposure therapy. This is what we would call it in the realm of psychology, exposure therapy. And it's based on the premise that our fears are sometimes irrational, often have an irrational component. And the only way to really overcome a deep-seated fear is to face it. That's what exposure therapy means. So for example, if you had a fear of cats, it's really tough to address that fear of cats without it involving a cat in your life at some point. And so you would encourage people to think about cats, and then eventually perhaps you would go to the Humane Society, you be in the same room with a cat, and perhaps you'd eventually pet a cat. And so how do we do this when it comes to money? Well, I encourage people to spend some money on something that's ridiculous for them, something that feels like an indulgence. It feels ridiculous. And for my extremely money vigilant clients that I've worked with, sometimes like a fancy cup of coffee just feels like ridiculous, like a $6 coffee. There's no way I would do that. And I think it's kind of fun to experiment with sending somebody to go buy that cup of coffee. Like clearly this individual can afford it, or I wouldn't be suggesting this. One of the routes to wealth, as you may remember, was the latte factor. I think it was David Bach who talked about how you can become a multimillionaire by just not buying that latte. This is sort of the opposite, where I'm encouraging somebody to go ahead and buy that latte, or go have an expensive dinner out with your husband or your wife or your partner, or go buy that $15 turkey sandwich. And I know you can make it at home, okay? And I know you can make it for pennies on the dollar, but just go ahead and try to do that, or have a massage. These are all things that I've actually had clients do. And we talk about it and process it, and they sort of get a chuckle around. You realize that perhaps you have an extreme sort of position around this spending money. So just as an exposure trial to spending some money on yourself, think about how you can enhance your life, even if just a little bit, by spending some money. Another way to address this is to look at spending differently. So many money vigilant clients, and I sort of fall into this category myself, in all honesty, have trouble spending money on themselves, right? It's like, oh, I don't need it. I can do without it. I really struggle to buy clothes, just to be honest. It's like, I have enough clothes. But if it's spending money on others, that's a lot easier for me, because I'm very connected with my family, my close friends. If there's an experience that I can spend money on that brings me closer to them or seems to bring a smile to their face, I'm much more willing to do that. Another frame is, owning your time. If you do have financial freedom, you have saved and invested. And what's the point of that? The point of that is owning your time. And so you can spend that with family and friends doing something fun or exciting. I also like the idea of investing in a vacation. A vacation seems, for those workaholics out there who are money vigilant, it seems like it's something that's unnecessary. Perhaps you haven't even done it in years. But if you could look at a vacation as investing in the relationships with the people you love most, it's a different twist on spending the money that can make it easier to do. Contributing to the well-being of your family. And as I mentioned, denying self-care, not great. There's a bunch of studies done on this too, but it increases your chances of dementia. So if nothing else, to motivate you to spend money on your healthcare, on your self-care, on getting a massage, on reducing your stress, on joining a gym, it'll actually help you out cognitively as you age. And then my last resort for individuals who I can't get to spend any money, and they have an abundance of resources, as I suggested, and I see them living almost like an Ebenezer Scrooge type existence. Now, if you remember the story of A Christmas Carol by Charles Dickens, Ebenezer Scrooge had money, but he wouldn't even heat his house, and he ate gruel every morning. He was denying himself this. He was living a life of poverty, which actually, when you trace the story back, he grew up poor. He had this fear of not having enough. So we don't want to do that. So as a last resort, what I like to encourage people to think about is, well, let's say that you've collected this money, you've saved it, you've invested it, you've got this nest egg, you refuse to spend any of it because you're so anxious. What's going to happen to that money when you do pass on? What's going to happen to that money? And I've literally seen this happen. And so I like to tell the story. where somebody's driving a 15-year-old broken down Toyota. By the way, they're fine at 15 years, but it's an aged car, right? And they have denied themselves. They don't go on vacation. They don't take care of themselves. They pass away, and I've literally seen their children take that nest egg and go buy a Mercedes like within 6 months. And this is sort of the atomic bomb intervention that I'll encourage people to think about is, well, what's going to happen to that money when you're gone? Do you have descendants who are not going to look at it in the same way as you do? You've probably heard the adage, which I won't get into the research around it, but where people have a tendency, and throughout cultures, the person who collects the money does really well saving and investing it. Quite often within the next generation or two, that money is gone because the individuals who are coming behind that person who's created that nest egg don't necessarily share the same beliefs around money, the same history of not having enough that drives people to save. So before it's too late, which is the theme of this presentation, if you are entering that distribution phase, and if you're not quite there yet, but you're approaching it, I just want you to think about some of the benefits of spending money, because your financial advisor is going to try to get you to do it. Because I think what we want more than anything for clients is a higher quality of life. And obviously we work in the realm of wealth and money, but that's what makes me happy. I mean, we could be doing any job we want. What we like to see are clients who are living their best life, who are able to use money in service of their values, their goals, their connection with the people they love. So you may hear us encouraging you to go buy a expensive latte or get a massage. And if so, just understand it's coming from this place of concern about you and wanting you to be able to enjoy your resources.
All right, I'll jump here. Federico, you probably wanted to say some things, but here we are. Before I start, I have to confirm, yes, I did go through Brad's content because I like it a lot. I learned a lot from it. That's why I felt comfortable to talk about him, but it's really his research. And what he didn't share, I'll share here. If you want to take advantage of our tests to find out what your money script is, please let us know and we'll help you out with that. I think it's a great conversation piece for your with your spouse. With that, I'll start my part. So the reason we called this presentation as Before It's Too Late, because we are approaching the year end, and there are certain things you have to do before year end. There are certain things that are good to do, and my part today, I'll try to share with you, is to bring your focus to those before Nick talks about our market outlook. So let's start with 529 accounts. These are education purpose funds, and there is no deadline to put money in a 529. In fact, the max is 500. You can go and put 500,000 in California in a 529. There's no annual deadline. That being said, if you want to take advantage of the gift tax exclusion, which is 17,000 per person per year per child, then you have to meet that 12/31 deadline. And if you're curious, the gift tax could be as high as 40%. You don't get the tax deduction in a 529 plan contribution, but your funds grow tax-free if they're used for education purposes. If you go above 17,000 per person per year per child, there's still a way to avoid the gift tax, and it gets to the lifetime exclusion, which is a little bit more complicated for the purpose of this presentation, but let us know and we can guide you through it. But if you are planning to make a contribution and take advantage of the gift tax, please meet the 12/31 deadline. Charitable contributions, you have to meet 12/31 deadline if you want to take advantage of the tax deduction. We advise that you use donor advised funds, the DAF accounts. As the name implies, you put your money in a donor advised funds. Those are for charitable purposes, and then the funds go out to your favorite charity from this account. And one advantage it has is that you can contribute a highly appreciated stock. So instead of selling your highly appreciated stock and writing a check to American Cancer Society, but in the interim pay taxes, you can just contribute your Apple stock in that highly appreciated stock directly in that donor advised funds. You can donate up to $100,000 to a qualified charities directly from your RMD funds. So this time of the year, we send checks and wires out to our clients because of their required minimum distributions, and it does increase their tax bracket sometimes. It certainly increases their tax burden. One way to avoid that, and if you are planning to make a contribution in that year, send it directly from your RMD so that tax consequence adverse effect is avoided. Health savings account. I used to be kind of sort of lukewarm about these accounts. I have become a big fan with that line for flexible spending after age 65. Nick alluded to this some months ago. It's one of the triple tax benefit accounts that you get tax deduction. It grows tax free and tax free distributions for health related expenses. But even if it's not health related, that's the beauty of it. After 65, you can use it just like any other qualified account, excuse me. You want to establish it in the calendar year. If you're working with your employer in this, contact them before year end. But your contribution deadline is tax filing. You don't have to rush for the contribution, but you want to talk to your employer before year end. The max amounts are on your screen per person and per family, and you have a $1,000 per person catch up if you're over 55. Next one is 401k contributions. Again, you have to meet 12/31 deadline. This is a no-brainer. If you haven't maxed out and if you have cash flow available, one thing that I'd like to mention is capital transfer, which means let's say you have 100,000 in a brokerage account. You can use those funds to, let's say, take care of your monthly needs while you max out your 401k, which most people don't realize they can. So if you haven't maxed out, we highly advise you do. Check with your employer before 12/31 so you adjust your withholdings to max out. Again, the amounts are on your screen. The 30,000 is the after 50 catch-up contribution. If you're self-employed and if you have a solo 401k, you're luckier because you're more flexible. Your contribution limits are also higher because it has a profit sharing piece to it. If you have any questions, let us know. This is a little complicated, but the point is establish it in the year. So next year, you're more flexible in your choices. Tax loss harvesting, we try to do this on behalf of our clients as much as we can. The idea is you exchange. I like to use that word because sometimes clients feel uneasy about selling securities that have losses. Why am I selling at the bottom the security that is in a loss? Because you take those losses and you buy back a like-kind security, and those losses offset potential realized capital gains in other securities. It is called tax loss harvesting. And to do this, you have again 12/31 as the deadline. If you don't, then there's nothing you can do. If another interesting thing most clients forget is see if you have carryover losses from last year. $3,000 is the max annual. And let's say you had losses last year, you didn't have gains, and you carried over, and this year you do. It's important to make sure you use those carried over losses for your tax purposes. Roth conversions, great conversation piece for financial planning, and thank you, Federico, for adding these charts to it. So before calendar year deadline, this has to happen. If you take money out of your IRA and if you put it in your Roth, it's called a Roth conversion, that amount is taxable income. And why would you want to do that? Well, if you are in a low income, low tax bracket year, this might be a year to take advantage of that. So let's say next year, you'll get a new job, or maybe you're expecting a promotion, or maybe this year is unusual for one reason or another. Instead of paying higher taxes because you'll be in a higher tax bracket, you want to take advantage of your low tax bracket status and pay less taxes. So the charts below do require an explanation, a translation. Let me go through that real quick. So on the left, you see those blue bars. Those are taxes paid by a particular client. And those horizontal lines, those are tax brackets. Now, client goes through certain stages in his or her life, and all of a sudden taxes go up. Why? Retirement. So the client is forced to take money out of their qualified accounts. But two, more importantly, even if they don't, RMDs, required minimum distributions. So the client jumps in two tax brackets, and then going forward for the rest of his or her life, stuck with it. Now, if the client did Roth conversions every year to the max of the second tax bracket, 12 to 15, then those years, the yellow bars are the taxes paid. Sounds like not a good thing to do, but what happens afterwards, the blue bars, for the rest of his or her life, she stays under that tax bracket, and retirement planning is cash flow planning, cash flow management. It becomes a so much more evened out cash distribution, and they also end up having a Roth tax-free distribution account that actually grows over time, which we didn't even talk about here. So if you are having questions about this, let us know. Let's run a scenario and see if this is a good option for you for your financial plan. Q4 tax payments, self-employed folks, I always see clients having trouble sometimes not having paid enough. Remember to pay, send the checks to the federal and state. W-2, if you know you're going to have a bonus, a stock that you cashed out, and you feel like you may be paying taxes more this year, make an estimate payment. You can, nothing is stopping you. If you thought that you paid too much or too little taxes for 2022, you have still time to update your tax withholding. For this year and next, the other part is every year you might want to do this. Talk to your HR, if you're W-2 employees, find out about your employee benefits and max them. We like, for most cases, group life insurances and group disability insurances are extremely attractive. Maybe max is an aggressive word here, but as much as your cash flow allows, let me put it that way. You're not going to get those deals outside of group policies, but it's a great habit before year end to review your employee benefits, give a call to your HR and make adjustments, because typically they have windows available for you to do so. Before Nick takes off with our market outlook, so far I have described the things to do that you have to do before 12/31. Next, I will talk about a few things that you don't have to do before 12/31. But if you get into a habit, I think you'll benefit from. Financial planning is such a wide, such a deep, such a big topic. It's difficult to touch on every one of them in a meeting, in one data gathering and then presentation. So it's good to spread it out, and it's good to keep going back. And if you get into a habit of looking at these items that I listed here, I think you'll benefit from. One of them is insurance planning. My wife and I got into an accident in April. And she's a financial planner and a truly better half, because she took care of that so well. We didn't really have to worry about it. First thing in my mind when we got hit by this other person was, ooh, are we properly insured? And thank my wife, we were. So get into a habit of reviewing your auto, home, life, disability insurance. I did talk about the group policies. A year-end project. Let's say this year, pick your insurance. Next year, maybe pick budgeting. Financial planning is cash flow management. Um, I just had a meeting with a client. We reviewed her subscriptions, and she was surprised to see how many subscriptions she has, and she doesn't even need, or she forgot that she does. And it adds up when you multiply by 12, apply another 20, 30 years to it. Estate planning, we talked about it, and the 529. Talk to us, talk to an estate attorney, find out, check if you have the beneficiaries lined up properly, because these things change. If you have a will, if you have a trust, debt review. You want to bring your fixed cash flow as low as possible to get you ready for retirement so you can relax and have positive cash flow month after month. Rates have gone up. So if you have credit cards that have gone up to 20, 25%, maybe it's a good time to check a HELOC option and refinance and maybe debt consolidation. Again, we're here to help you with that. Review your credit report. If you have a credit card that is being charged and you're not making payments and you're gonna be sent to collections, guess who will be there? Who will have to clean that mess up? It's you. So look at your credit report and see all your accounts are the ones that you want to have. And create a cloud vault to share sensitive documents. We have one for you through eMoney. If you don't know how to access it, let us know. You don't have to use that. It's good to have a vault for your sensitive documents because, like in California, we go through fires. If everything is up in the cloud, if things go and they get lost or misplaced or burnt, you have them up there, and so you can download and move on with your lives. That's it, folks. Thanks for listening. It's all you, Nick.
All right, thanks, Bora. Appreciate it. Good information, Bora. Good information, Brad. They left me with the fun part of the evening. You know, everyone likes to talk about this market, I'm sure. So we'll get through it together. I want to kind of lay kind of a little bit of groundwork or framework. So we utilize a lot of our charts and our indicators are from Ned Davis Research. Ned Davis Research is a world-renowned research provider known for objective, data-driven approach. They take 4 pillars of the market, and we looked for a balanced and weighted evidence approach on where the market may be heading and where opportunities and where risks may lie overall. So the 4 pillars are, macro, that's economy trends, fiscal policy, monetary policy. Those are more expectations, how the market should be acting, but it's more bigger picture and slower moving. So macro can be decoupled from what the market's actually doing for a long period of time. The same thing with fundamental as well, which is basically company earnings. So they can be well away from historical means or norms, but that's still something underneath the scenes that will come to light at some point in time in the future. Faster moving indicators, or how the market is actually acting, is more technical, which is like momentum, volatility, trends, volume, and sentiment, which is crowd psychology and investor behavior. So I just kind of want to review that real quick. Just to send the groundwork. I'm going to go through each of the investment pillars. I picked a couple different charts from each of the different areas to kind of explain the story of the market, if you will, and maybe where we see things heading or what's happening overall right now. So I'd like to review this, and if you were on the last call or you've listened to me before, I usually start with this because I think it's good conceptually to understand normal economic and market cycles. They don't always exactly go this way, but it happens to be that the time frames on this and this last market cycle has pretty much played out to a T. I'll start on the left-hand side. We start out with some kind of recessionary bear, which eventually gets into a recession. which we can think about that as COVID. It was a very short-lived recession. We got to extreme pessimism. When everyone is pessimistic, that's actually a contrarian indicator. So that makes the bar really, really low, and everyone's expectations are really low. So coming out of a recession, we have a really, really strong rally, usually lasts 1 to 2 years. So you think in your head, late 2020, 2021, that's a period of extended mean reversion, multiple expansions on earnings, but eventually the market gets overly optimistic and gets overbought, and that leaves us complacent for some kind of market downturn. Lots of times coming out of a recession, eventually we get in our heads like, well, what if we are going back into a recession, or the economy is not as strong as it is? So it's very, very common in a market cycle to have what's called a echo bear. And that's a non-recession echo bear, which means we think we're going into a recession, but we don't actually get into the recession. So now think in your head 2022, where the market goes down, 20, 22%, but we don't actually have a recession. And that gets us to the point where we're, again, very, very pessimistic. And so we had extreme pessimism readings in September and October of 2022, which sets up this longer term, potentially post-echo bull. It's not as strong as this post-recession bull, because basically a non-recession echo bear doesn't go down as much. A recession bear goes down 35%. A non-recession bear maybe goes down 20, 25%. And so since we don't go down as much, we don't have as much mean reversion. We also, since the recession didn't happen, we don't have as much stimulus overall. And so this is generally the longest period of a secular bull market, which can last from 6 months to 5 years. And so that's where we believe we are in, but it can last, like I said, any time from 6 to 5 months, years. And once this echo bull is over, guess what? We start over back into the recession and ongoing. But this can be a very long period of time. So technicals, again, technicals are momentum, volatility. It's telling us why the market is acting a certain way. So you probably thought about the election maybe, and been talking about it or heard about it. I know I hear about it all the time. It's coming. Well, there's two rough parts in a normal cycle for an election cycle. And this is average market returns in a 4-year election cycle. And there's two rough patches. One rough patch is before eventual presidential election, which is where my mouse is November of next year. So it starts kind of right where the market peaked out in July. And generally we go through a rough patch until October, November, and we end with a year-end rally, but we're more range bound. Historically, the market actually starts to get it together closer to election, which may sound counterintuitive, or maybe counterintuitive with this election coming up. But once some uncertainty is relieved from the market, generally we get some momentum from that overall. Well, the second roughest patch is actually starts to be the year before midterm elections. And the market at the end of that year starts to go down on average, and is mostly range bound until we actually get into midterms and we have more certainty again. So we're in what is a normal rough patch and just an election cycle anyway. However, most years do end on year-end rallies, and that just has to do with seasonal weakness. And now there's some other indicators that I'll tell you why I still believe that a year-end rally is on the table, and a very, very good possibility overall. I think you have to understand kind of the market where it is right now. This rally coming out from September to now has been significantly narrow, meaning the whole market really hasn't participated in this market. It's really just been, 6 to 10 stocks that have really got really good gains, that did terrible in 2022 and have done really good in 2023 as a mean reversion. Also supported with some AI optimism that's really kind of propelled that overall. But it's not healthy for a market to just lean on a few stocks. So this is the percentage of S&P 500 stocks outperforming the S&P 500 over the past 3 months. Generally, we're at 50%. And anything above 50%, it says, hey, well, that's a healthy breadth of a market. Most stocks are participating in this movement overall. And we did get that coming out of September. But in June, and I talked about this in our last webinar, only 16 or 18% of stocks in the S&P 500 were actually outperforming the S&P 500 at that time. all of it was being carried by just a handful of stocks overall. And historically, for a rally to continue, we need the rest of the stocks to join the party. So that started to happen. It's waned off a little bit with the consolidation period, but this is healthy for the rest of the stocks to join the party. So right now, about 10 stocks make up 30% of the market capitalization of the S&P 500. Historical mean is 22%. So there's a lot of basically faith in only 10 stocks overall. And I'm saying that not to be worried necessarily. I'm saying that there is an opportunity potentially. Like when we look at the S&P 500, it is up for the year. But if we look at the Dow Jones Industrial, it's pretty much flat for the year. If we look at an equal weighted S&P 500 index, it's pretty much flat for the year. So there still is room for improvement on a broad market basis. So this just gives you some statistics. This is kind of what would happen in a year where the first half of the year we're up by 10% plus, which has happened this year. Generally, we have a weak third quarter. So the third quarter on average, when the market's up by more than 10%, is down about 5.7% is the mean. However, the fourth quarter after that occurs, the average mean is 6.8% up, and that happens 80% of the time. So is that going to happen this year? History from a technical basis, some technical things are showing that this could possibly occur. This is a normal cycle composite just for the year. And I brought this up in our last July meeting, and there were two things I was concerned about in our July meeting. One was I liked that the market was broadening out. So I said that was a positive. But two concerns I had was the cycle composite usually peaks in this year from an election cycle, and even on a normal basis around July, and then August, September are seasonally weak months, even September, October, but October, November starts to get stronger, and November, December starts to get stronger as well. But also there was excessive optimism at that time, which made us a little bit complacent, and we were due for a consolidation or a correction. We've had that, and some of that sentiment has definitely gone down from the excessive category, which I'll show you in a little bit. But this is the same thing I had last webinar in terms of like in the mid-year, we said these were the risks in the second half. And now that we're a little bit further in the second half, I thought I'd review these. Economy slowing. Really, the economy's still chugging along. This third quarter GDP estimates are pretty high right now by the Fed overall, and the economy's been pretty resilient. Fed hikes, well, that's still going on. Earnings per share expectations, we actually had a really good quarter in terms of earnings beat rate. Excessive optimism was a risk, but that's waned off. So now we're more in a pessimism zone. So that's actually good for a year-end rally. And potential for the second half. The banking crisis hasn't crept back up, but we haven't gotten this broadening that I wanted to really get. And if we get this year-end rally, we'll really be looking at the broadening of the overall market. So this is just some basic technical analysis, nothing real complicated here. We had a 200-day moving average on the stocks, which puts us right at the 4,200 level for critical support. It also goes up against a couple peaks in the past here. So when we were looking at the market and how much this correction or consolidation period, we knew there was going to be some support here at 4,200. Now this is very recent. This happened, what, 4 days ago, 5 days ago? We touched the support, we bounced off it. We've had 3 days up, 4 days up maybe. We'll probably hit some resistance, but I wouldn't be surprised if we hit this 4450 area just purely from a technical basis. However, this bull market has been weak. It's the second weakest bull market in the last 50 years. Weaker bull market was in the 80s, but the next year followed up with like a 27% return. We were a little slow out of the gate overall. One, because I don't think we had much of a bear market. It may have felt like a really bad bear market from historical terms. That non-recession bear market was on the light side. Like we barely got over the 20% mark. So we don't have as much mean reversion. So I think that's part of this overall. But the S&P 500, we were getting close to kind of historical averages, which is the blue line, but we've waned off a little bit. Cyclical growth sectors have been kind of right on average. Cyclical value sectors have been underperforming a bull market average. And then defensive sectors, which you would think that they would do well if the market is really worried about a recession. But the recession has been pushed out. We think really in 2022, we pushed out to 2023. Now we're pushing it out to 2024 at the very, very least. But also with the defensive sectors, there's also another game in town, which is you can get a nice yield from just treasuries and money market and bonds overall, that you don't need to get into utilities and staples to get a good dividend yield necessarily. So there could be some, these are probably the cheaper sectors of the market overall in terms of valuation, even financials. But so far this has been kind of weak. So I'd like to see things kind of broaden out. So this is basically what I'm talking about with the breadth of the market. So this is the percentage of stocks that are over their 200-day moving average. And so when coming out of when September of last year, we had a run, and in January, February, we hit a little peak here. There's a little pullback in March, and then we hit a peak in June and July. Now we're looking for this to retest. So we'd like this broadening here to happen and be higher than these last peaks. Otherwise, we may be going through a topping process where we get lower highs on a breadth basis, meaning stocks participating in the overall market. And that would indicate not as healthy of market. So that is kind of yet to be determined at this point. All right, fundamentals. So fundamentals, you buy stocks create earnings, stock creates cash flow, dividends. So you want to be cognizant of where they are from a valuation standpoint. The good news is, and I had this chart last time, but I updated because we have a new quarter's number of earnings, is that 80%, and that's these lines here, is the percentage of S&P 500 companies that beat their earnings estimate. And for a couple quarters here, we've been on an upward trend overall, and that's actually positive. So we actually had a pretty decent quarter in terms of earnings. What's not as good is that on the top line, we're having a little bit of trouble. So on the sales beat rate, it's actually gone down. So earnings are up and sales are down a little bit. Now, this is still above history if you look in the past. So it's not necessarily something to be saying, oh, well, that means we're going into a recession immediately. No, I just think what it means is that the economy is not growing significantly. We're just kind of treading water and going sideways. The reason earnings have gone up is because companies are pretty resilient and they've gotten better at a couple things. They've been better at cost containment, cost of goods sold. They're understanding the inflationary environment and the supply chain interruptions. They also have a new income source, which they didn't have before, which is companies that are cash rich now get interest income. So there are things helping out earnings rates overall, but we'll be looking at the sales beat rate, moving forward. So our stock's cheap, one measure is price to earnings ratio, and this can be out of the line with the overall market expectations, but on a 1 year forward earnings ratio, I would say based on a mean, they are expensive. We're at this 19 level, and on a mean basis, should be at like 15.3. On an operating ratio, we're pretty close to fair value. On a last 4 quarters basis, we're pretty close to fair value. But this is a little bit misleading up here, because remember I talked about the narrowness of the market. When I take out the top 8 companies, the actual valuation of PE ratio is actually much better, and we're more at fair value overall, because the top 8 companies make up 28% of the market, 28% of the S&P 500, but they only contribute 17% of the earnings of the S&P 500. So they are being weighted higher by the market in terms of their market cap, but not contributing as much in terms of their weight equal to what earnings they're producing. And some of this has to do with the hope and the promise of AI, and maybe some movement to the mega cap because they did so bad last year and there's some mean reversion overall. But a lot of the market is fairly valued. From a valuation standpoint, I could argue that some of the elite 8 may be a little overly valued in comparison to a historic mean. So I think this is one of the biggest things right now that stops the market from moving up significantly, is that the S&P earnings yield is now higher than a 3-month treasury. And this bottom chart is basically the S&P earnings yield minus a 3-month treasury. And you can see it boosted up way up here. And we're actually in a negative territory. TINA is there is no alternative. When interest rates were 0, there was no alternative to the stock market. The term was cash is trash. Everyone should invest in stocks. Well, now it's Terra. There are reasonable alternatives. You do make money on your cash. And that affects how much valuation we want to put on the market overall. However, there has been periods of time, if you look in the 90s, where we were at a negative rate here. And the 90s is the perfect example of a soft landing. So the mid 90s, it was the end of an interest rates, cycle where the Fed was tightening and then they were lowering rates and they achieved a soft landing, no recession. Now, a lot of that had to do with earnings. And earnings where companies were multiplying very quickly because it was this birth and the beginning of the internet and these tech companies. And you could translate that to maybe this is the beginning of something with AI and producing more productivity and increased margins. So there's only one of two ways to fix this and get back into a positive territory. Either earnings go up or a combination, or interest rates go down. Either way helps out the earnings yield versus the treasury yield. All right, macro. So macro, I think, is the most talked about things. It's the most dinner conversation topic because I don't really hear people talking about earnings yields and PE ratios at dinner, but everyone does like to talk about when are we going into a recession? Are we going into a recession? Are interest rates crippling us? Or is the economy resilient? Like most of it revolves around macro. So this can be decoupled though from the market on a pretty long period of time because we look out not what's happening now, but what we think is going to be happening, and then the market makes adjustments accordingly. So there's some good news here and there's some mixed news here. The good news is globally, this is our recession probability model. It's gone from a high probability to a low probability. And that is good, meaning the economic numbers from a global standpoint have gotten better over the course of the year. And generally when it's in this area, that's when our best returns are out of all the different areas in this low probability model. Now, there are some parts of the world that aren't doing great, like the Eurozone, but there are parts that are doing good, like India and emerging markets. And the US is actually holding on really, really good. So from a global standpoint, we're holding in there, and the probability of a recession at this point is we feel is low. Could that change in 6 months? Could that change in 9 months? Yes. But right now we're in a low probability section. So given that, we have to think about when the market's really being looked through the Fed's eyes, and everything I think comes back to the Fed and comes back to interest rates because it affects the valuations of the market, affects whether we really think we're going into a recession or not. We believe that we're closer to the end of the tightening cycle than the beginning of the tightening cycle. Could that mean 1 more rate hike, 2 more rate hikes? Sure. But more than likely, we're near the end. And I'm going to give another chart that supports that. But to give you some context, this line is when the Fed hikes rates the last time, and then what the market does after that point. So historically, we actually get a rally, but then it fails. Because generally the Fed has done a bad job of over tightening and pushes us into a recession. And I know that's not what everyone wants to hear, but that's just what happened in history. There has been cases of soft landings. But however, since Greenspan, I highlighted here, since Greenspan actually occurred, the market's actually been positive once the last rate hike has occurred, except for in 2000 here. And again, 1995 is our best case for a potential soft landing, where 126 days later, the market was up 18%, 252 days later, the market was up 35%. So we have to keep that in mind that there still can be some legs to this overall. The economy is not at a near recession point, and there could be some bullish tailwinds as well. So just want to keep that in mind. Credit conditions is kind of a boring chart. I brought it up because I brought it up last time. This economy functions on free flowing capital and credit. it's fine. It hasn't, it's actually come up since the March banking issues and kind of holding steady more in a historical norm of what it was from 2012 to 2020. So interest rates haven't affected the credit conditions as of yet. The consumer's popping up a little bit, on consumer debt overall, but it's still below a historical average in percentage in terms of income to debt overall. One of the big misses I think that people had this year was the amount of stimulus that occurred, and it was kind of a stealthy stimulus. So Social Security is 1/5 of the line of the budget, basically. And there was an 8.7% increase in Social Security. So that gave $100 billion of stimulus this year. And we're going to get more stimulus next year, where Social Security recipients are going to receive another, I think, 3.2% overall. It's going to be coming down, but it's still going to be stimulus. As well as tax brackets gotten wider due to the inflation. They expanded all the tax brackets, so some of your money wasn't taxed at a higher rate. And a lot of people had capital losses from last year, so that saved on some capital gain taxes. So there was some kind of stealthy stimulus that happened that wasn't really headline news, and we'll still have some next year with a Social Security increase. So inflation, how long will this disinflation last? So this is the rate of inflation here. You can see we went on this peak here. We've been coming down. We ticked up a little bit here, but that's completely normal, but the trend is still down. The tough part is going to be the last 1.5% to get where the Fed wants to get to. We've come down pretty good, but the last part might be a little bit stickier. The year-over-year comparisons aren't going to be as easy. Most of the supply chain has been fixed, or we've been working with that, overall. So really, the inflation is here, but it's come down pretty significantly and more manageable level. Historically, when inflation gets really high here, what usually wipes it out is a potential recession overall. But we're not seeing any of that on our economic indicators, and hopefully the Feds learn from past policy making runs that they can navigate this in between inflation and the economy overall and interest rate environment. But we do think we're still in a low inflationary environment that's popping up. Generally, that's when we have the best type of market returns. More than 75% of central banks have paused. Last time I showed this chart, we were up here. Now we're down here. So only 23% of banks have actually raised their rates in the last 8 weeks, the US being one of them. So most of the world right now is kind of on the pause already. I don't think we're too far off from the pause. However, not too many have actually lowered rates. There's been a few, but not too many overall. If this gets down, this clip gets down here, and this gets down to here on the bottom clip, that's generally your best market returns from a historical standpoint. So this is Federico's favorite chart because it just looks awful. Every time I see this chart, I'm like, oh, I got to explain this one again. So there's the Fed funds rate at 5.5%, and there's inflation at, let's say, 3.7%. The difference between the two is the real Fed funds rate. Well, we started out where we've never had to start out before, where basically we are at 0% interest and we had all this inflation. So you could borrow money next to nothing, but you still had this inflationary environment. So it was a negative real funds rate. So no wonder, we were pretty resilient in all these things. But generally, we don't start at this low. So the Fed had to work a lot to get us to an area where the real Fed funds rate was actually positive. And the real Fed's funds rate being positive actually then gives some restriction, makes it sufficiently restrictive financially. And so we're at that point, and we're actually a little bit above this point. This was as of 7/26. They haven't updated the chart as of yet. When we get into this range here, which we're not that far off, generally that's enough to be restrictive economically. And that's generally, all these lines are past tightening cycles. And that's when usually the Fed calls it quits in terms of raising interest rates. And we're there. One more rate hike, or inflation comes down a little bit, we're there basically, you know, overall. So since we're talking about that, I get a lot of questions about bonds, and I get a lot of questions about when are they going to do something. And lots of times they do something well before the Fed says they're going to do something. So this is what generally a 10-year Treasury note does between the last rate hike to the first rate cut. And generally there's about an average of 6 to 8 months between the last rate hike to the first rate cut. So even before the Fed says we're going to cut, even before the Fed says we're going to pause, the market sniffs it out and basically will take off 0.75% off the 10-year Treasury. So already bonds are starting to appreciate at that point in time. So the market doesn't wait for that to occur. They anticipate it, and either it comes to fruition or then they have to kind of backtrack overall. This, I think, is probably the most powerful chart of all of them, because this is why I think we are at where we are. When you think about the 80s and you know, high inflation and then going into a recession, one thing they didn't have was this massive amount of stimulus in the recession. And we are still working through that stimulus. This is estimated cumulative excess savings since April 2020. And there's still an extra $1 trillion out there above the linear trend line. So yes, the lower class is getting hit with inflation and it's squeezing their wallets, but they're fully employed. So they're making money and they're spending money. The middle class is actually saving money, and as a percentage of their overall income is going up because they're actually making some money on their money in terms of cash sitting at the bank or in money market funds. The same with baby boomers as well. So interest income is actually going up. But this is what keeps us in the game, and it's a very, very dangerous proposition to kind of bet against the American consumer overall, especially still with this much excess cumulative savings. So sentiment is crowd psychology, investor behavior. It's very contrarian. It feels the exact opposite of the way you feel. I'll just explain this a little bit. When this is up here, that's excessive optimism. That's when everyone is really excited about the market. They've already bought into the market. Maybe they're getting very complacent overall, and that sets us up potentially for some kind of correction or consolidation. Where extreme pessimism is the exact opposite. Extreme pessimism, if you're already pessimistic and you had plenty of time to be pessimistic last year, you sold, you haven't got in the market, you see the market go up a little bit, you get FOMO, you want to jump in, you know, and that pushes up the market even higher. So we were in extreme optimism in July in our last webinar, and I said, well, really, we're due for a consolidation, we're due for a correction. 5 to 10% would be healthy, and it would take off some of the optimism to get us into a pessimistic zone to continue moving forward. Well, that's happened. We've gone all the way down to extreme pessimism, and that's where our best gains are. And that's what sets up an end of year rally, getting into the extreme pessimism zone from roughly a bad August and September. Would I have liked this to come down a little bit more? Yeah, and so that's why I'm not completely confident that the rally is starting right now, but we are in that extreme pessimism zone, which may give us a nice lift here. This is on a more shorter term basis. On a more intermediate term basis, you know, September of 22, we got as pessimistic as basically the market was in the middle of COVID, which we didn't see a recession at that time. We saw no need to then pull back in September of 2022 because there was no recession and there was extreme pessimism, which we know set up this rally going on. Although it's been weaker in some areas, we like it to broaden out. You know, it set that up. But we went all the way to this extreme optimism zone. And if you can remember back to my very first slide, we do this over and over. I'm not in the screen, over and over again. Extreme optimism, extreme pessimism. So now we're back in a pessimistic zone. I wouldn't be surprised if we get back into the optimism zone. Generally, the first time in the optimism zone isn't a rally killer, and we can stay there for a long period of time overall. But this is kind of setting up this potential rally at the year end. So I'm sure that was a lot to digest. These are my final thoughts. The market is looking through the Fed's eyes. Monetary policy is restrictive. Most of our economic indicators say that we're heading away from a recession, but it's going to be difficult for inflation to get down to 2%. And so the market is worried about the Fed and the Fed overdoing it. And the next year may feel stagflationary, which means slow growth overall. And that's kind of what you want for now until the Fed actually reverses course. Because if the economy is too hot, inflation comes back, the Fed pushes interest rates up. The economy is too slow, we go into a recession. So they will have to thread this needle between the recession and inflation risks. Bonds should become a lot more competitive once the Fed pauses. Bond pessimism is actually higher than stock pessimism. And when that happens, usually bonds actually outperform stocks. So there is some traction there overall, and we think there'll be a potential good environment for bonds potentially next year. Right now, our recession watch indicator, which is 10 different indicators, only one of them is flashing, and there's generally a lead time associated with it. So we don't see kind of imminent recession 2023. Potentially there could be one, down the road. But this market kind of, the way we're trending is following the tendencies of a secular bull. And until that's broken, then I think you should stay put in kind of the investment allocations you have, and that, there still could be legs in the market overall. So that is all I got about the market. I'll turn it back over to Federico and see if there's any questions.
Perfect. Well, thank you, Nick, and thank you, Bora, and thank you, Dr. Klons. I think everybody here can appreciate that. I know we're a little bit over on time, and I don't see that there has been any questions so far. So, just to respect everybody's time, we're gonna leave it as is for now. But if you have any questions or anything that comes up, feel free to reach out to us, reach out to your advisor. You can email us as well on the info@ymwadvisors.com. Thanks again for joining us tonight, and hope everybody has a great night. Thanks again. Take care.
Bye, guys.